If you only looked at the stock market headlines this week, you probably think everything suddenly went wrong. Artificial intelligence stocks sold off, oil prices surged, interest rates climbed, and investors started questioning whether this year's biggest winners had simply gotten too expensive. But here's what's interesting. This wasn't just another bad week in the market, it may have been the beginning of a rotation that every retail investor needs to understand. Today, we're breaking down exactly what happened between July 19th and July 25th, why it happened, and more importantly, what smart investors should be watching next week. For nearly 2 years, artificial intelligence has dominated the market. Companies spending billions on AI infrastructure saw their stock prices soar because investors believed these investments would transform nearly every industry. But eventually, every great trend faces a simple question: where are the profits? This week, investors finally began asking that question. Many technology companies continue spending enormous amounts of money on AI research, new data centers, and advanced chips. While these investments may pay off years from now, Wall Street has become increasingly focused on whether those future profits justify today's extremely high stock prices. History teaches us that this isn't unusual. We saw something similar during the dot-com boom around the year 2000. Companies with incredible technology attracted enormous excitement, but many stocks became priced for perfection. When expectations become too high, even excellent companies can see their shares fall. That's exactly what happened this week. It wasn't necessarily bad news, it was simply investors adjusting expectations. At the same time, another story was unfolding. Geopolitical tensions in the Middle East pushed oil prices sharply higher. Many investors underestimate how important oil is to the overall economy. Higher oil prices increase transportation costs. Shipping becomes more expensive. Manufacturing costs rise. Eventually, businesses pass those costs to consumers through higher prices. That's inflation. When inflation increases, central banks become less willing to lower interest rates. And when interest rates stay higher for longer, growth stocks, especially technology companies, often struggle. It's a chain reaction that affects nearly every asset class. One of the biggest mistakes new investors make is only watching stock prices. Professional investors spend just as much time watching bond markets. This week, Treasury yields climbed as investors worried inflation could remain elevated. Think of interest rates like gravity. When rates are low, expensive growth stocks can continue climbing because future earnings become more valuable. When rates rise, those same future earnings are worth less today. That's why technology stocks often struggle when bond yields move higher. This relationship has defined markets throughout much of the last 4 years. Understanding this connection gives retail investors a major advantage. Perhaps the most important lesson from this week wasn't the market decline, it was where the money actually went. While technology sold off, investors bought energy companies, defense contractors gained strength, industrial businesses attracted new capital. This is known as sector rotation. Money rarely leaves the market completely, it simply moves somewhere else. Successful long-term investors recognize these shifts early instead of chasing yesterday's winners. Every market cycle creates new leaders. The goal isn't predicting every move, it's recognizing where institutional money is flowing. So what should investors monitor next week? First, watch Treasury yields. If yields continue climbing, technology could remain under pressure. Second, pay close attention to oil prices. If geopolitical tensions ease, energy prices may fall and relieve inflation concerns. Third, continue watching earnings guidance, not just earnings beats. Markets care far more about where companies are going than where they've been. Finally, look for signs that institutional investors continue rotating into value, industrial, and energy sectors. If that trend continues, leadership within the market could continue changing. The biggest takeaway from this week is simple. Markets are constantly changing. The companies leading one month may not lead the next. The best retail investors don't panic during volatility. They stay informed, they understand why money moves, and they position themselves for the next opportunity instead of chasing the last one. If you found this market recap helpful, subscribe to Market Insight Weekly for clear, data-driven analysis every week. Until next time, invest wisely.